As you are aware, the speaker for this session will deliberate on related party transaction for private company and life after exemption notification under 462 for private company, planning the affairs. So it's a very important notification which came in the 4th of June. And you all are aware, Manoj Banthia is very regular in our institute. He is a past chairman of Institute of Company Secretary of India Eastern Region, and he is also a chartered accountant.
Good afternoon, friends. From natural elements to electronic elements, everything seems to be working against us. Bad weather that perhaps explains the sparse attendance that we have today. These days, what you listen to speakers about the provisions of law, what you read are not necessarily what is intended. The meanings can be quite different. I understand. At this very platform, not even a month ago, an officer from a department comes and says, this is the provision of law. And today, from that very department, another officer comes and says, no, this was never intended. That's not the provision of law. The law today is this. Nothing has changed in the last 1 month. There is no new notification to that effect. But nonetheless, you will have to keep on changing your understanding with respect to the provisions of law. I can also take a clue from the notice with respect to today's seminar, broadly publicized as seminar on NBFCs, but I am not going to speak anything on NBFCs. Let me clarify this. Maybe with respect to the provisions of Companies Act, insofar as they are relevant to non-banking financial companies with respect to the topics that I am touching, I'll surely take you through them. But otherwise, my talk today has got no relevance to non-banking financial companies at all. Maybe Mohit's talk certainly has got relevance as far as NBFCs are concerned, but mine doesn't. Friends, related party transactions as far as private companies and unlisted public companies are concerned, and notification exempted private companies from certain provisions of the Companies Act, I would not like to see them as two different topics. I would like to see them as one combined topic, and I would like to take you through those provisions together. I will start my discussion on the exemption notification that has come under section 462, and I'll try and tell you how the provisions of the Companies Act could apply differently to private limited companies with respect to the exemptions that has been provided to them. When it comes to related parties, I will also try and explain as to how these provisions will apply to private companies in the chain scenario, and how would they apply to other unlisted public companies which are not deriving any benefit out of this particular exemption. It is better late than never, and this exemption notification, which came sometimes on 4th or 5th of June, was almost more than a year after the Companies Act 2013 was promulgated. And interestingly, it was almost a year after the draft notification was put before the Parliament for its confirmation. So it took almost a year. Maybe the draft notification was put on 12th of July 2014 to be precise, and then the notification has come on 5th of June. Now, one interesting issue that comes up is, what is the effect of this notification? Is this notification a prospective notification, Does this notification also benefits me to the extent that I can even take some advantages which are retrospective in nature? I'll try and explain. There is a section 117 in the Companies Act which says that certain resolutions which you pass under section 179 subsection 3, you are required to file with the Registrar of Companies. Now on 5th of June this notification comes and this says that this particular clause 117 3G will not apply to private limited companies. Suppose a private limited company on 23rd of May, when this notification was not in existence, passes a resolution, a board resolution, which is required to be filed with the Registrar of Companies under section 179(3). What would be the fate of that particular resolution after 5th of June? Am I required to file or am I not required to file? The event has happened before the notification came into place. So my obligation to file the form has occurred before the notification came into place. Am I required to file or am I not required to file? Secondly, say on 13th of April 2014, I passed a resolution. I am a private company. When I say I passed a resolution, I am only referring myself as a private limited company. A private limited company passes a resolution for granting of loans to certain persons. This granting of loans under section 179 is required to be filed with the Registrar of Companies. I have not filed that resolution. Today the notification comes into place. That resolution which I passed almost a year back, for which I had an obligation to file for about almost a year by now, should I file that resolution now or should I not file that resolution now? While there is no doubt that any piece of legislation, unless it is specifically intended by the legislature itself, is always prospective in nature. It cannot confer any retrospective benefits or any retrospective obligations. Nonetheless, I would be of the view, as far as the first point is concerned, where I still had the time to deposit the forms. I said on 29th or 23rd of May, suppose I pass a resolution, where I still had that 30 days window, and before that window expires, the notification had come in, I would be clearly of the view that in such a situation, I will be entitled to benefit of this particular exemption and I will not be required to file any form with respect to those resolutions that I have passed. As far as the second situation is concerned, I will again take a practical view that any legislation which is beneficial in nature and where the intention of passing on the benefit is known to us for almost a year by now should be construed accordingly, and hence something which I had defaulted filing at that point in time, the Registrar of Companies could have taken action against me for not filing such forms at that point in time. Today, when the law provides me with the benefit, I would still like to take that benefit and I would still not like to file any form, even with respect to those resolutions which I had passed earlier. I am again repeating it very, very consciously that this is a practical viewpoint that I would like to take. This may not necessarily be totally legal, because my obligation was at that point in time, I had an obligation to file that form, but looking at the intention of the legislature, where the intention was clearly to provide me with this benefit since July 2014 itself, though it might have taken almost 1 year for that particular notification to come. And today the situation is that the Ministry of Corporate Affairs has already withdrawn those forms which you are required to file, with respect to these items. So even if you want to file, you don't have that particular form whereby you can file these with the Registrar of Companies. So in such a scenario, my viewpoint would be that there is no doubt that the amendment is prospective in nature. Nonetheless, any filing obligation which is pending, and if the benefit has come to me now, I can overlook those filing obligations. I can take advantage of the beneficial legislation. I can take you through several case laws on retrospective law, where the Supreme Court itself has held that if the legislation intends to provide any benefit to the person, and if that benefit would not, today, if that benefit would have extended even beyond that period, then the law would take its retrospective effect and the benefit would be available to that particular entity even before the law had come in place. Having said so, let us quickly look at the specific, some of the important exemptions that have been made available to private limited company. I would start with section 2, subsection 76, subclause 8, which is in respect to related parties. Here we would also try and cover the provisions relating to related parties also. Friends, section 2, subsection 76 of the Companies Act 2013 defines the term related party. Who is a related party? There are about 8-9 entities which have been listed out in section 2, subsection 76, and those are your related parties. Those are related parties for the company. This notification says that subclause 8, totally there are 9 subclauses. Subclause 8 in relation to a private limited company will not be a related party for the purposes of section 188. 188, I am sure you all are aware, deals with related party transactions. So with reference to section 188, subclause 8 of section 2, subsection 76 will not be treated as a related party for a private limited company. Now what does this mean? First, what is this subclause 8? This subclause 8 is that in relation to a company, its holding company, its subsidiary company, its associate company, and its fellow subsidiaries are its related parties. My holding company is my related party, my subsidiary company is my related party, my associate company is my related party, my fellow subsidiary is my related party. Subclause 8 lists out these 4 entities as your related parties. Now these entities will not be your related parties by virtue of this exemption notification, but only for the purposes of section 188. Which means if there is a transaction between a private company and its holding company, then that will not be treated as a related party transaction. If there is a transaction between a private company and its subsidiary company, that also will not be treated as a related party transaction. Likewise for associate companies, likewise for fellow subsidiaries. Right? Now, X Limited is the holding company of Y Private Limited. X Limited is the holding company of Y Private Limited. They enter into a transaction. Will that transaction be a related party transaction? Yes or no? X Limited enters into a transaction with Y Private Limited. I am looking this particular transaction from Y's point of view, not from X's point of view, because we are dealing with private limited companies now. So for Y Private Limited, because it is a transaction with its holding company, X Limited, will it be a related party transaction or will it not be a related party transaction? Yes or no? By virtue of this notification, my holding company is not mine, so it will not be a related party transaction. Yes? Now here there is a slight catch. Had it been X Private Limited, your holding company, then there was no problem. But the moment I say X Limited, your holding company is a public company. A subsidiary of a public company, even if it is a private limited company, it becomes a public company by virtue of definition. So your Y Private Limited, though it is a private limited company, because it has a holding company which is a limited company, Y Private Limited becomes a limited company. So this transaction is not a transaction between a public limited company and a private limited company. This transaction now assumes character of as a transaction between one public company and another public company. Those companies, what I am trying to tell you here is that if you are a private limited company which has a public company as its holding company, then that benefit will not be available to you. Only when you have another private limited company as your holding company, then this benefit will be available to you. But your subsidiary company can be a public company, can be a private company, doesn't matter. Your associate company can be a public company, can be a private company. Similarly, your fellow subsidiaries can either be public or private. Only when it comes to your holding company, be careful that if your holding company is a public company, then the scene changes. Clear? Now, it will not be a related party for the purposes of section 188. But as far as other sections are concerned, if there is any other section in the Companies Act which deals with related parties, then there is no exemption from that section. Say section 177 of the Companies Act, which deals with audit committees. One of the function of an audit committee is to approve and modify all transactions with related parties. If such a private limited company happens to be a company to which this section 177 applies, and if it enters into a transaction with its, say, subsidiary company, for the purposes of 188, it may not be a related party transaction. But for the purposes of section 177, it would still be treated as a transaction with a related party, and the compliance of section 177 will still be necessary. Am I clear? So what I am trying to tell you is that the exemption is only limited to the provisions of section 188, that is related party transactions. The exemption does not extend to other sections of the Companies Act. Right? Section 43 and 47, friends, will come a little later if time permits. They are not so important provisions, but will take up other issues. Section 43. Section 43 basically defines shares into different classes. Equity shares with differential voting rights, preference shares. This exemption notification says that where the memorandum and articles of association of a private limited company so provides, this particular section will not apply to a private limited company. So if you have a provision in your articles of association which says that a private limited company can have any class of shares, whether equity, preference, differential, or even any other third class, fourth class of shares, then section 43 will not be applicable to you. In other words, subject to a provision contained in its articles of association, a private limited company can now have any type of shares in its memorandum of association or in its articles of association. Now, sir, how can there be any different class of shares? Shares either have to be equity or preference. What would be other classes of shares? You have to be innovative enough. For example, shares with differential voting rights are there. You can come out with shares with different seniorities even. For example, within preference shares even, you may say that X class of preference shares will rank in seniority compared to Y class of preference shares. You may have shares with same voting rights, but you may still say that these are management shares and these will have voting rights 3 times more than the voting rights of these particular shares. Which means you can be innovative with respect to either voting rights, either with respect to dividend, or with respect to seniority, or with respect to preferential treatment in the event of winding up. It would totally depend on you how you would like to structure your capital. So in case of a private limited company, that flexibility has been provided to you. I am not sure whether many of us would be willing to avail such flexibility, whether that at all would be necessary or not, but private limited companies can avail such flexibilities. Section 47. Friends, section 47, to quickly tell you, deals with 2 issues. One, that in case of shares, the voting rights will be in proportion to the amount of capital paid up. which we all know that yes, it is always in proportion to the amount of capital paid up. The other part of section 47 says that in case of preference shares, if their dividend has not been paid for a continuous period of 2 years, then preference shares will also be entitled to have voting rights equivalent to equity shareholders. Now, some gentleman writes this notification and he says that for a private limited company subject to a provision contained in Memorandum and Articles of Association, the entire section 47 will not apply. Now see the interesting part. If I am a private limited company and I say that those who have paid rupees 5 per share and those who have paid rupees 10 per share, every shareholder will have a voting right irrespective of the amount paid upon that share. Even if you have paid 5 rupees or I have paid 2 rupees or I have paid 10 rupees, so long as I am holding a share, we all will have equal voting rights. Suppose my article says, that's quite possible. I have not an argument with that. But look at the other provision. Suppose a private limited company issues preference shares, and for a period of 3 years, the private limited company does not give any dividend. Then the preference shares become equivalent to, they have voting rights equivalent to equity shares. And by memorandum and articles, if the private limited company says, no matter whether I pay or not, preference shares will never have any voting right, because by virtue of this exemption notification 47 doesn't apply to me. I don't think that is intended. This is unfortunately, as is very, this is something very, very consistent with the Companies Act 2013. This would not have been intended at all. Any benefit which the law perceives to be given to any particular class of shareholders, that cannot be taken away by virtue of exemption notification. So my view would be that though section 47 doesn't apply to private limited companies, but nonetheless the benefit which this particular section provides to, the privilege which this section provides to preference shareholders, that cannot be taken away by this particular exemption notification. I hope you have understood what I was trying to tell you, that the privilege which is there for preference shareholders under section 47, this exemption notification cannot take away that privilege. It can provide other benefits, but taking away the privilege would be against the provisions of the Act. Right? 62(1)(a) and 62(2). Friends, 62(1)(a) deals with rights issue of shares, and 62 subsection 2 provides the timeline. 62(1)(a) also provides a timeline which says that your offer, letter of offer, should be open at least for a period of 15 days. It should not close before 15 days and not later than 30 days. And then subsection 2 says that yes, it has to be dispatched within 7 days from the date of closure of the offer, and those things are mentioned in subsection 2. What the exemption, what it does, it doesn't provide you exemptions from 62(1)(a) or 62(2). The only exemption that is provided to you is that these timelines are not applicable to you. But as a private limited company, you can have a lesser period of time. The 7 days can be reduced to 3 days, or the 15 days window which is to be there for an offer period can be reduced to a 3-day offer period window as such. There is no other, the benefit is only with respect to timelines. The benefit is not with respect to the entire subsection or the entire section. Clear? So if you are a private limited company, but then again there are certain conditions that you need to satisfy, provided that notwithstanding anything contained in subclause and subsection 2 of this section, in case 90% of the members of a private company have given their consent in writing or in electronic mode, the periods lesser than those specified in the said subclause or subsection shall apply. So you need approval of how many members? 90% of the members in writing should have given approval to you, and only thereafter these timelines will not be applicable to you. So you will have to first take approval from those 90% of the members, and then you will have to proceed with the lesser timelines, which means you will have to approach shareholders twice if you want to come out with a lesser time, if you want to keep your rights period for a lesser timeline. First approach the shareholders, get their consent for a lesser period, and thereafter open the issue for a lesser period. This again may be practically very, very difficult. Approaching shareholders twice may not be a very feasible idea to do, but nonetheless, some benefit can definitely come to private limited companies where allotments are to be made in a hurry because money is, in case of rights issue, there is no requirement of keeping the money is blocked, but nonetheless, the person who has put in money would also like to have certificates as fast as possible. 62(1)(b) is with respect to your stock options, where special resolution is now converted into an ordinary resolution for a private limited company. 67 is not that relevant. 73(2) clauses A to E. I'm sure Mohit might be touching on this particular clause, but nonetheless, since insofar as it relates to private limited company, let me touch upon this. Friends, 73 subsection 2, one thing that you need to understand is that the exemption is not from the entire section 73 subsection 2. 73 subsection 2 allows any company to accept deposits from shareholders. 73 subsection 2 allows you to accept deposits from shareholders subject to certain conditions having been fulfilled. Those conditions are clauses A to clauses F of section 73 subsection 2. The exemption is from applicability of clauses A to E, but not from clause F. Clause F would still be applicable to you. Now, what are clauses A, what are clause B, what is clause C, D, E? If you satisfy these conditions, then these clauses A to B will not be applicable to you, and the amount of deposit which you can take, not exceeding 100% of aggregate of its paid up share capital and free reserves, and such company shall file the details of money so accepted to the registrar in such manner as may be specified. Which means a private limited company has two advantages and one obligation. The advantage is that it doesn't have to comply with clauses A to E if it has to accept monies from its shareholders. Second advantage is that it can accept money up to 100 times of its paid up capital and free reserves. And the obligation is it has to file with the registrar of companies a statement. The details of monies which may be the form is not yet devised, but once that form comes into place, it will have to file that form with the registrar of companies. Now, friends, A to E. A says that you will have to issue a circular for accepting deposits. B says that this circular has to be filed with the registrar of companies at least XYZ days before accepting such money. C says that you will have to have a deposit repayment account wherein at least 15% of the deposits maturing during this year or during the next year will have to be put in a separate bank account. Clause D says that you will have to provide deposit insurance. Right? Clause F deals where you are, where deposits are secured, where you are providing security on while accepting deposits. Wherever deposits are secured, this exemption benefit is not available to you. The benefit is available to you only when you are issuing unsecured deposits. Normally deposits are unsecured, so this benefit will generally be available to private limited companies. So it is a major benefit because private limited companies, if they are accepting monies only from their shareholders, they will not be required to keep that 15% deposit repayment account. They will also not be required to have any deposit insurance. They will not be required to provide any deposit insurance to their deposit holders. But what is the quantum which they can accept? The quantum is they can accept up to 100% of their paid up capital and free reserves. This, unfortunately, you have provided me exemption saying that these provisions of the Act will not be applicable to you. But you forget that you have also come out with rules. And you forget that these rules say a different story. The maximum amount which any company can accept from its shareholders is only 25%, which is provided in the rules. Unless you amend those rules also to say that in case of a private limited company, subject to conditions being satisfied, it would be 100%, there will be a conflict between this exemption notification and the rules. Second point that I want to stress here is, the exemption is from clauses A to E, not the entire subsection 2. Subsection 2 starts by saying that a company can accept deposits from its shareholders by passing a special resolution. So this requirement of passing a special resolution is not done away with. That special resolution has to be passed. Thirdly, suppose the provisions contained in the rules, insofar as they don't relate to clauses A to E, they will have to be complied with. For example, there is a rule which says that the tenure of deposit cannot be less than 6 months and cannot be more than 36 months. You have to comply with that. Or suppose that there is a rule which says that you will have to issue a deposit receipt. You will have to comply with all those requirements. Only those requirements of clauses A to E and the corresponding requirements in the rules, only they stand waived. You don't have to comply with them, and the amount which you can accept, though there is a conflict between the rules and the exemption notification, but if I take the exemption notification being more recent and being more beneficial, you can accept up to 100 times of your paid up capital and free reserves. But you have an obligation, you will have to file with the registrar the details of all such monies accepted. Right? (101) to 107 and section 109 will not apply to private limited companies unless it is otherwise specified in the respective sections or your articles of association. Very, very important. And the provisions contained in the erstwhile section 170 of the Companies Act 1956 are restored. If you remember section 170 of the Companies Act 1956, it stated that the provisions contained in section 171 to 186 of the 1956 Act, unless it is otherwise provided in the Companies Act 1956 or in the Articles of Association of the company, they will not be applicable to a private limited company. Same position has been restored. 101 is the length of the notice for convening a general meeting. In case of any company, what is the length of the notice for convening a general meeting? 21 days. But if you have a provision in your articles, you can reduce that 21 days to 7 days, 3 days, 2 days, 1 day in a private limited company. So drafting of articles in case of a private limited companies, as far as the provisions of meetings are concerned, becomes very, very important. You can take advantages of all these provisions and you can accordingly draft your articles of association. But if there is something specifically provided in these sections for the private limited companies, then you cannot do away with those provisions. For example, suppose there is section relating to quorum, and it says that quorum in case of a private limited company is say 2 members personally present. You cannot provide in your articles that 1 member personally present and 1 member present by proxy will form the quorum. That cannot be provided. Because it is clearly provided in the Act itself that for a private limited company, 2 persons will have to constitute a quorum. So it has to be 2 persons. Right? So this again is a very, very beneficial provision as far as private limited companies are concerned. But the most important and the most some economic benefit, if any provision that is provided is section 117(3)(g). I am sure there have been times when after every board meeting, many of us were busy only filing form MGT 14 with the registrar of companies, attaching one resolution after the other. Most of them, while attaching, we always felt that we kept on attaching these documents, these forms, and whenever any loan was taken, whenever any investment was made, whenever any borrowings was done, whenever any TMP was appointed, internal auditor was appointed, secretarial auditor was appointed, whenever we did anything, we perhaps thought whether this particular clause is debt attracted or not, whether we are required to file the forms or not. Some notification which came in April 2015, if I am not wrong, it perhaps eliminated almost majority of the requirements which were there in the rules for filing of the forms. I think 3, 4, 3, 5, 6, 7 and 8 were deleted. So that was one major benefit that came in April. But as far as private limited companies are concerned, this is a major benefit. You are not required to file any form with the registrar of companies as far as the resolutions under section 179 subsection 3 are concerned. So now in case of a private limited company, all that you are required to file is special resolutions, resolutions with specific majority, and board resolution only in case of appointment of managing director and not otherwise. So there is no other resolution that you are required to file with the registrar of companies. Right? So if you have, as I have already explained, that if you have already passed a resolution which required filing, passed a resolution before the notification came in, and if it required filing, don't worry, don't go ahead and file. I can tell you, the registrar is not going to prosecute you for the same. Chartered accountants, I am sure, must have been very happy as far as this particular notification is concerned, because the number of the limit on the number of audits that you can have also included private limited companies before this exemption notification came in. And now, private limited companies, small companies, one-person companies, government companies, they will not be counted for the purposes of calculating the limit of 20 audits. Somewhere else I mentioned that the damage has already been done. Unless you are a company where rotation of auditors is a must, all the companies would have already appointed auditors for a period of 5 years. Because that was the law, auditors should be appointed only for a period of 5 years. If you have to change the auditors now, either you will have to follow the process of resignation or you will have to follow the process of removal. Both of them are again slightly tedious. In case of resignation, it has to be a board meeting followed by a general meeting. In case of removal, special notices and approvals of central government, general meetings, all would be necessary. So I personally feel that yes, the damage is already done, but nonetheless, it would be some benefit where still trust and relationships exist. There will still be some benefit to chartered accountants, because now they can audit more than 20 companies, subject to, of course, institute's guidelines, whatever restrictions the institute has put in, and private OPCs and small companies will not be included in that limit. Another major benefit which has been given to private limited companies is by making section 160 not applicable to private limited companies. Section 160, 162, 180. All these three will not be applicable to private limited companies. Section 160 and 180 are very, very important. If you remember, last year I was flooded with several calls, telephone calls. Sir, 8 lakh रुपया लेना पड़ेगा. क्या हुआ ना सर, चेक लेके रख ली और जमा नहीं दिए और फिर बाद में वो इलेक्ट हो जाता तो वापस रिटर्न कर देते हैं. If you are appointing any person other than a retiring director as a director of your company, section 160 stated that you will have to deposit a sum of rupees 1 lakh before such a person can be appointed as a director. So this was a major issue as far as private limited companies are concerned, because at least even for a period of 15 days or 20 days or 1 month, that sum of 1 lakh or 2 lakh, that's blocked, and you will have to keep it in your account before you return them, or at least check kaat ke rakhna padta tha. Now this section will not apply to a private limited company. So in case of private limited companies, this taking of deposit or taking of any requisition from shareholders for appointing a director will not be necessary anymore. Similarly, section 180. Section 180 is comparable to section 293 of the Companies Act 1956, where board can exercise certain powers only after obtaining approval from the shareholders. Under the 1956 Act, section 293 was applicable only to a public company and not to a private limited company. But the 2013 Act made section 180 applicable even to a private limited company. So if a private limited company had a borrowing in excess of its paid up capital and free reserves, it was required to file a form, it was required to pass a special resolution and file necessary form with respect to such special resolution. This section 80 will not be applicable to private limited companies. So now, if you are borrowing in excess of your paid up capital and free reserves, no resolution of shareholders needed. If you are selling, leasing or disposing whole or substantially the whole of the undertaking of the company, if you are a private limited company, then you don't require any approval from shareholders. Board resolution will be sufficient to carry such applicability. 162, friends, is not that relevant, but then again, the law is that if you want to appoint two directors, then you will have to pass two separate resolutions. More than one director cannot be clubbed, cannot be appointed by a single resolution. This is what section 162 also says, but it will now not be applicable to private limited companies, which means private limited company can appoint Manoj Banthia and Mohit Butaria together as directors in their company. By a single resolution, you don't have to pass two different resolutions. This is very, very interesting. A private limited company where husband and wife are directors, and husband is sought to be paid certain remuneration. The resolution comes up before the board of directors that this resolution of paying remuneration to the husband, who is Mr. X, is to be approved. There are only two directors. Mr. X is interested in this particular resolution because money is being paid to him. Mrs. X is also interested in this resolution because Mr. X happens to be her relative. So both the directors are interested in this resolution. There is no quorum. There is no director at all. How will you pass this resolution? How will you pass this resolution? Previously, we had the benefit of, whenever such a situation arose, we had the benefit of going to shareholders. We always used to approach shareholders. Now, this company has only two shareholders, Mr. X and Mrs. X. Under the 1956 Act, this was not a problem because you are interested in a company only as a director. Your interest as a shareholder is not in conflict with the interest of the company. Understand? As a director, I am in a fiduciary capacity. As a shareholder, I am the owner of the company. As a director, I may act in my personal interest and not in the interest of the company. As a shareholder, when I act in my personal interest, it is always in the interest of the company, because my interest and company's interest are one and the same, right? So it was always, even if you are an interested director at the board meeting, it was permissible for you to vote at the general meeting. But now you have section 188, which says that if you happen to be a related party, and since transaction relates to appointment of a person, you will not be allowed to vote on that particular resolution. Of course, subject to thresholds being crossed. This exemption comes in as a relief, and it says, if you disclose your interest at the meeting of board of directors, then you can participate in such meetings and you can also vote at such meetings, no matter even if you are interested in that particular resolution. So in this situation, if both wife and husband disclose their interest in this particular transaction at the meeting, husband will say that this resolution concerns me, I am interested. Wife will say that I am relative and hence I am interested. If they disclose and then they participate and they pass a resolution, it is still a valid resolution. So this is really a major, I would say, a very big step where they recognize that small companies or private companies, almost everything is interested resolution only. So saying that you should have a disinterested quorum is only trying to bring in outside people into family companies, which may not be a very welcome step. So this is a welcome change as far as private. This benefit is available only to private limited companies and not to public companies. So in case of private limited companies, even if you happen to be interested director, disclose your interest and participate at the meetings. But then disclosure is must. Without disclosure, you cannot participate. If you participate without disclosure, then that is a wrongful participation. You will not be treated as it will not be treated as a valid resolution, right? And this again I must clarify here that that earlier exemption doesn't exempt you from the provisions of section 189 or the provisions of section 184. The exemption is only from the provisions of section 184 and not from the provisions of section 189. Suppose you are entering into a contract with a related party where you are interested. 189 says that that contract has to be entered in the register. You may disclose your interest and participate, but 189 which requires you to enter that contract in the register, that has to be done. The benefit is only of participation and voting, nothing else. This, friends, an exemption which was waited for a long time, but when you look at the actual nature of the exemption, it really makes you feel very sad that this in reality is no exemption at all. This is merely an eyewash. Friends, section 185, perhaps one of the most tormenting sections of Companies Act 2013, a section which has troubled the corporate sector and even today is troubling the corporate sector, and I am sure corporate law consultants all across the country would have been put questions on section 185 more than any other provision of the Companies Act. This section 185 is comparable to section 295 of the Companies Act 1956, and section 295 of the 1956 Act was not applicable to private limited companies. So initially in the draft stage, when this particular notification came in, there was lot of expectation that the entire section 185 will not be applicable to private limited companies. But unfortunately, look at the conditions they have imposed. The conditions will ensure that no private limited company is ever able to take benefit of this particular exemption. What are the conditions? It will not apply to a private limited company if, now what are those conditions? In whose share capital no other body corporate has invested money. Which means you should have only individuals as your shareholders. You should not have any body corporate as your shareholders. I really doubt how many private limited companies exist with only individual shareholders. Secondly, if the borrowing of such a company from banks or financial institutions or any body corporate, not necessarily from banks, even ICDs, is less than twice of its paid up share capital or 50 crores of rupees, whichever is lower. Friends, I am sure you all must be auditing several balance sheets. The paid up capital is 10 lakh and the share premium is 110, say 1 crore 10 lakhs. It is always paid up capital and share premium which is much more higher. The paid up capital always remains less. Generally, the paid up capital always remains less. If your paid up capital, you are allowed, even if your borrowing is twice your paid up capital, which means suppose I have a paid up capital of 1 lakh and share premium of 49 lakhs, my total reserves, my shareholders funds would be 50 lakhs, but if I have borrowed even 2,10,000 rupees, this exemption is denied to me, because it is only twice your paid up capital, not paid up capital and free reserves or securities premium assets. It's only 2 times of your paid up capital. So this is a major restriction. And it is not monies borrowed from banks and financial institutions, even ICDs. Perhaps here the Companies Act has been influenced by the Reserve Bank of India, where they have the definition of public funds, where they also include ICDs in the definition of public funds. So even ICDs, if you have in excess of twice the paid up capital, this benefit will be denied to you. And finally, if such a company has no default in repayment of such borrowing subsistent at the time of getting liability. What I am trying to tell you is, if only 10%, if I am not wrong, 10 to 15% of all private limited companies would be such private limited companies where there are no bodies corporate as shareholders. Secondly, out of those, it is highly unlikely that those companies would not have borrowed monies in excess of their paid up capital, twice of their paid up capital. This exemption, in reality, that is my understanding, will not be available in general to private limited companies, and it is only a very few and handful private limited companies which will be able to avail this particular exemption. So it's not a major benefit as was expected. It's only a small benefit only to small section of private limited companies that this benefit will become applicable. In whose share capital no other body corporate has invested. What do you mean by this? If I go by the language, in whose share capital no other body corporate has invested. Invested at which point in time? Suppose there was a shareholder, body corporate shareholder, and he sells his shares, and today he is no more a shareholder in the company. If you look at the language, in whose share capital no other body corporate has invested, it had invested. So it was a company in whose share capital a body corporate had invested. They could have been more clearer as far as the language is concerned. They could have clearly said that at the time of making of the loan, the company does not have a body corporate as a shareholder. They would have taken care of this entire thing. Instead of twisting the language, which again I am sure I know as far as we are concerned, we will always say that it will be at the time of making of the loan that he should not be a shareholder. Now suppose I have 3 bodies corporate as shareholders, and I have taken loans from bodies corporate. I transfer those shares, I repay all those loans. So I don't have any body corporate as a shareholder, I don't have loans from any body corporate, I don't have any loans at all, say. Then I give money. And tomorrow, those bodies corporate again purchase the shares back. So if this restriction is should this be a continuing restriction? Should this be a restriction only at the time of making of the loan? Normally I would understand that this would be a restriction only at the time of making of the loan. How can you control transfer of shares even subsequently? What I am trying to tell you is perhaps not very happily worded. It can be misused by the corporate sector, it can also be misused by the regulator to punish the corporate sector. Either ways it can be used. Section 188.1 deals with related parties. Section 188 deals with related parties. It is second proviso to section 188 which will not be applicable to private limited companies. Now let us try and understand the entire section 188 with respect to private limited companies. Section 188 says that a company can enter into transaction with its related party only with the consent of board of directors. What are those transactions? The transactions are provided in section 188 subsection 1. Transactions for sale, purchase or supply of any goods and materials, transactions relating to any service, agency contracts, transactions relating to appointment of persons to any office or place of profit. This is what is section 188 subsection 1. Then first proviso to this section says that if the value of the transaction is, if it exceeds such amount as may be specified, then you will also require approval of shareholders by way of a special resolution. Second proviso to section 188 says, 188 subsection 1 says, that all those persons, all those related parties who are interested in that particular transactions, they will not be allowed to vote on that transaction. And third proviso said that if the transaction happens to be in your ordinary course of business and if it is at an arm's length price, then the provisions contained in section 188 subsection 1 will not be applicable. This is what is section 188. The transactions are listed in section 188.1. Transactions with whom? Transactions with related parties. Transactions with related parties. Who are related parties? Related parties are provided in section 2, subsection 76 of the Companies Act. Clear? So if you happen to enter into any transaction which is listed in section 188 subsection 1 with a related party, then you have to comply with the requirements of section 188 subsection 1. One exemption that we have seen is that in case of a private limited company, 2 subsection 76 subclause 8 will not be treated as a related party. That was the first exemption which I have shown you. So your holding company, your subsidiary company, your associate company, or fellow subsidiary is not your related party. But all others from 1 to 7 who are listed, they are all your related parties. Clear? Your relative is your related party. Any partnership firm in which the director or relative is a partner is a related party. Any private limited company in which the director is either holding a share or is a director, he is a related party. In any public company in which the director is a director and along with his relatives holds more than 2% of the share capital of that particular company, then that public company is a related party. Any person under whose instructions, directions or advice the board of directors of the company is accustomed to act, then he is also a related party. Similarly, any holding company, subsidiary, blah blah blah, they are also related parties. But this holding subsidiary, by virtue of that exemption notification, in case of a private limited company, it will not be by a related party. So transactions which are listed in section 188, if I enter with these related parties, I will have to comply with section 188. What is the compliance? I will have to pass a board resolution. But if the value of transaction exceeds what has been specified in the rules, Rule 15 specifies the quantum. If it exceeds that value, then you will have to pass a special resolution. You will have to pass a prior special resolution. At this special resolution, related parties will not be allowed to vote. Only unrelated parties can vote on this particular special resolution. Related parties will not be allowed. However, if the transaction is in the ordinary course of business of a company, and if that particular transaction, is on an arm's length basis, then neither board resolution is necessary nor special resolution is necessary. 188(1) doesn't apply to such transactions. Clear? Now see, in case of private limited companies, one related party has become less. By virtue of their exemption notification, holding subsidiary, they are not my related parties. The second benefit that I get is, this second proviso is not applicable. What is the second proviso? Related parties are not allowed to vote. That proviso is not applicable. So in case of private limited companies, if you have to pass a special resolution, even related parties can vote on that resolution. I told you about the husband-wife example. If the shareholder, say the transaction is in relation to the husband, where both the shareholders are interested, and if the transaction is of such a quantum that it is required to be passed by special resolution, in such a case, even both the shareholders, though they are related parties in the transaction, they will still be allowed to vote on such a transaction. The second proviso will not be applicable to private limited companies. Clear? Friends, as far as these related party transactions are concerned, as far as listed companies are concerned and other unlisted public companies are concerned, the only difference is that all those additional requirements which are mentioned in clause 49 of the listing agreement, which are applicable to listed companies, they will not be applicable to those unlisted companies. As chartered accountants, you all understand that Accounting Standard 18 requires you to disclose all related party transactions. As per AS 18, you are required to disclose all the related party transactions. Under Accounting Standard 18, any transfer of resources or obligation is a related party transaction. There is no material concept. Any transfer of a resource, any transfer of an obligation is a related party transaction under Accounting Standard 18. Which means if one company gives an advance to another company, money is moving out from this company to another company, there is a transfer of resource from this company to another company, so it will be a related party transaction. Suppose one company gives a guarantee on behalf of the other company, it is an obligation which is moving out from this company to that company, it will be a related party transaction, which are all be required to be disclosed under accounting standard. But as I told you, under section 188, it is only all those transactions which are listed. Transactions relating to sale, purchase or supply of goods and materials, transaction relating to transfer of property of any kind, transaction relating to sale or lease of property of any kind, transactions relating to provision of any service, transactions relating to agency contracts, whether it be selling agency, whether it be real estate agency, whether it be purchase agency, transactions relating to appointment of any person to an office or place of profit. Those are the only transactions which are covered under section 188. But accounting standard, the definition is different. Accounting standard has a very wide definition. 188 has a very narrow definition of related party transactions. In case of, as far as the Compliance of Companies Act is concerned, whether it is listed company or unlisted company, the moment you are entering into a transaction which falls under 188.1, you will have to comply with 188.1. But if you happen to be a listed company, then clause 49 says that even accounting standard definition, whatever transactions which are treated as related party transactions under the accounting standards, they will also be treated as related party transactions for listed companies. So this is a major requirement for listed companies, where a combination of the Companies Act and the accounting standard together will have to be taken to comply with the requirements of related party transactions. Whereas unlisted public companies, only section 188 and nothing else. Right? Accounting standard 18 again is a disclosure requirement. Don't mix accounting standard 18 with section 188. A transaction may fall under accounting standard 18 but may not fall under section 188. A transaction may fall under section 188 but may not be covered by your accounting standard 18. Don't mix both of them. As an auditor, accounting standard 18 is a disclosure requirement. You will look it from accounting standard 18 point of view and do whatever disclosures are required to be given. As far as compliance is concerned, if you have to check company law compliances, you will have to see whether those transactions are covered by section 188.1 or not. If yes, then whether provisions of section 188 have been complied with. Right? But as far as private limited companies are concerned, even for private limited companies, 188 is applicable. The only exemption is the number of related parties, one party is less. And the other benefit which is available to them is that they can vote even if they happen to be related parties. They can vote at general meeting also. Whereas other related parties, in case of unlisted public companies or in case of listed companies, they will not be allowed to vote. Right? Perhaps the last major benefit which this exemption notification has provided is